Welcome to Kharoo channel. We are solving the exercises of depreciation chapter, and in this video we are going to solve practical problem 1, that is on page number 245. On 1st April 2015, Farid of Nashik purchased a motor car of rupees 55,000. On 1/4/15 there is purchase of motor car for 55,000. And the scrap value of motor car was estimated at rupees 10,000 and its estimated life is 10 years. So scrap value is 10,000 and life is 10 years. The registration charges of the motor car was rupees 5,000. So we know this, that the registration charges of the motor car was rupees 5,000. We know registration charges or any other charges that were required, that were mandatory to bring the asset in its working condition. Without registration charges, motor car won't be able to go on the roads. So this is compulsory expense and we will add this to the cost of asset. 5,000 as per accounting standard 10, we will add to the cost of asset all the expenses that are required. All the required expenses we will add it to the cost of asset. And here when scrap value and life is given, percentage is not given, we will use the formula of depreciation as per SLM method. Cost of asset minus scrap value divided by life, we will get depreciation per annum. Correct? Then show motor car account for first 4 years, assuming that the books of accounts are closed on 31st March every year. So your journal entries is not asked, only motor car account we have to prepare for 4 years. 15-16, 16-17, 17-18 and 18-19. We will start with working note 1, calculation of depreciation on motor car as per original cost method. Depreciation formula is equal to cost of asset minus scrap value divided by useful life of asset. What is the cost of asset? 55,000 plus registration charges of 5,000. This will be total 60,000. 60,000 less scrap value. What is the scrap value? 10,000. And useful life is 10 years. Divide by 10 years. So this will be 60 minus 10 is 50,000. 50,000 divided by 10 is 5,000. This depreciation amount is per annum. So what will be the total depreciation? Particulars rupees. The asset was purchased on 1st April 2015 and the cost of asset is 60,000. So every year, since this is straight line method, every year the depreciation amount will be same as it is used for whole year. Less depreciation for FY 15-16, 5,000. WDV as on 31/3/16 is 55,000. From this, depreciation for FY 16-17, 5,000. Then the WDV at the end of second year will be 50,000. Then for third year, depreciation again will be 5,000. And WDV will be 45,000. And in fourth year, depreciation will be 5,000 again. And WDV at the end of fourth year will be 40,000. So if this is written down value method or reducing balance method, then you need to do this kind of working. But this is original cost method, that is straight line method, you can see that the depreciation amount is same every year and the asset is only one and it was used for whole year in all 4 years. So instead of doing this long cut, you can directly go for depreciation. How to calculate WDV at the end of 4th year will be 60,000 minus depreciation per annum into 4 years. 4 years the depreciation amount is same. So for 5,000 for 4 years, this will be the total depreciation amount, 60,000 minus 20,000, and the WDV at the end of 4th year will be 40,000. So you can do this working only for straight line method and when the depreciation amount is same for every year. If in the year of purchase or in the year of sale the transaction is taken place in between the year, then the depreciation will be calculated for proportionate period, for the period the asset was used. So in that case the amount will not be 5,000, it will be reduced depending upon the months the asset was used during that period. So if you are not sure when to do this, when to take this shortcut, go for long cut, you will surely get your answer right. Instead of getting wrong answer using any shortcut, better be safe. What the question has asked? Motor car account for 4 years. As the working is ready, posting will be easy. We are going to open motor car account. The asset is motor car. We know when the value of asset increases, when the asset comes in, we debit, and when the value of asset reduces or when the asset goes out, we credit. Correct? So with this revision and the working we have above, we will start our posting. Right? The asset was purchased on 1st April 2014. That time what will be the entry? Motor car account to bank account, to cash or bank account, generally bank account. And we know this amount is 55,000 plus 5,000. You can directly write 60,000. This is for your understanding. This might happen that 55,000 is paid to the supplier, 5,000 is paid to the government or some other entity. So it's okay. You can show it as one entry or separate entries. It's up to you. In 11th standard, it is okay when the details of supplier, the names of supplier is not given. So 160,000 entry is enough. Then during the year, there is no other entry. So we'll pass a depreciation entry at the year end 31/3/2016 by depreciation account. Depreciation account debit to asset account. The amount is 5,000. So at the year end, we will close the books 60,000, 60,000, and the closing balance is 55,000. Correct? This is 5,000 and this is 55,000. This will be 31/3/16 by balance close down. Next day, 1st April 16, we will carry forward this amount 55,000 to balance brought down 55,000. Correct? Then in next financial year, there are no other entries, only one depreciation entry. So at the year end 31/3/17 by depreciation account 5,000, and we will close the books 55,000, 55,000, and at the year end closing by balance close down, this will be 50,000, right? 55 minus 5 is 50,000, and we will carry forward this amount on the next day 1/4/17 to balance brought down 50,000. Correct? 5,000 and 50,000. In the third year, again 5,000 no other entry, 31,380 by depreciation account. We are crediting the asset to reduce its value, right? And the value is reducing because of depreciation. The amount is 5,000. And then we are closing the books, 50,000. There are no other entries. Okay. So at the year end, buy balance closed down, 45,000. And opening on next day, first 418, to balance brought down, 45,000. Correct? This is 5,000 and this is 45,000. In the last year, again, same 5,000 is the depreciation amount. There are no other entries. 31,319 by depreciation account, 5,000, and we'll close the books. There are no other entries. 45,000, 45,000. We'll balance this. This is 40,000, 45 minus 5, and the closing balance will be by balance closed down, 40,000. Next day we will carry that amount forward, 1st April 2019, to balance brought down, and this amount matches with this amount. Depreciation was 5,000 and the closing amount, closing WDV at the end of 4th year was 40,000. So the posting is correct. This is how the posting of 4 years is done, which matches with our calculation. That's it for the video. If you find this video useful, please like the video, share it with your friends, and subscribe for the future notifications.